Okay, good afternoon, everybody. So glad to have you back on another weekly Lunch and Learn. I'm Joel Landon, your host from Heritage IRA, and I've got a guest with us today, Patrick McClatchy from PPR Capital Management. Happy to have you here, Patrick.
Hey, Joel, thank you very much. I appreciate you having me on. Excited to touch on some things in the industry, especially in the private equity space, things of that nature.
Yeah, we're pumped. We love bringing people on every single week, and I know you and we got connected at the end of the year last year, and we've been trying to put this together, and I'm excited. We've been able to help some of the investors over at PPR, and we love what you guys do. You guys have an awesome process, so excited to hear from you. I'm going to be admitting people into the meeting. We've got people jumping into the lobby, which is awesome. We have some live guests or attendees. You might be watching this as well as a recording, and we've got some resources for you here at the end to get in touch with Patrick and PPR Capital Management. So tune in, listen in. I know it's going to be good content. Before we get started, just want to mention everybody's going to be on mute. That's joining us live. Cameras are going to be off. This is really just an opportunity for Patrick to talk through what PPR has to offer, what they have to offer you as an investor. You might be an investor today. You might even be an investor at PPR, but our hope is that you'll walk away with some good insights into this industry, into this asset class. So tune in for sure. I want to read a quick disclaimer here. Let me pull this up. This is something I always like to bring up at the very beginning. Before we begin, I want to briefly note that today's discussion is for educational and informational purposes only. Heritage IRA does not provide tax, legal, or investment advice, and we do not endorse or recommend any specific investment sponsor or offering. Any discussion of potential returns, tax treatment, or strategies, including alternative asset investing, is general in nature and may not apply to your individual situation. All investments involve risk, including the potential loss of principal. Alternative investments such as private real estate credit are illiquid and may carry additional risks. We encourage all attendees to consult with their CPA or your tax advisor, financial professional before making any investment or tax-related questions or decisions, sorry. So with all of that being said, Patrick, why don't you take a minute, introduce yourself a little bit more, talking about yourself professionally. Feel free to share some of the things you like to do personally as well. I noticed in your bio that you like to spend time in the snow or in the mountains, and I'm in Salt Lake City. And so maybe you'll touch on some of the things that you like to do for fun. And then of course, talk about PPR. Let people know right off the bat kind of who you guys are, what you stand for, and then we'll get into the meat and potatoes.
Awesome, that works. Thank you all again for joining. I do appreciate it. My name is Patrick McClatchy. I work for PPR Capital Management. My official role is a relationship manager, which really resides in working with the clients hands-on. Current clients that have been with us from 1 day to 20 years, and then potential people who are looking to hear more about us, who we are, what we do, things of that nature. I reside in Philadelphia, so wherever you are, you probably or most likely have better weather than I do currently, at least the past few months here. And PPR is also headquartered right outside of Philadelphia. So we're technically in King of Prussia, if you're familiar, about 40 minutes outside the city. PPR itself, we've been around now 18 years, coming up on 19 years in a couple months here. We got very popular from a few things. So number one, if you're a real estate investor or educate yourself in real estate, you might be familiar with the organization of Bigger Pockets. Bigger Pockets is probably the nation's largest, I guess you can call it, real estate organization, primarily for education based to help people get into real estate investing, learning how to make profit on real estate, all hard, tangible assets, really, in a broader stroke. And we really set the platform there because we have a niche way to invest in residential real estate. And I'll certainly get much more into that when we do go further into detail of what PPR invests in. But that really kind of set the stage starting in 07, 08, up until present day of where we really got our backing, our following, and our trust from investors. A little bit about me personally. I do reside on the East Coast, but I travel very often. Like Joel mentioned, an avid snowboarder and skier, so you'll very often find me on the West Coast. I also like to travel to Europe and Asia for some riding as well. So pretty much if there's any good mountains or snow, you can likely find me there in the winter. During the summer, spend a lot of times with family and things like that. But also with my role in relationship management, a big piece of that is traveling to clients, conferences, and things like that. So I do thoroughly enjoy getting to see new cities, new places I haven't been before.
Awesome. Wonderful. I appreciate that background and in bio. I didn't know that about your guys' presence on Bigger Pockets. I know that Bigger Pockets is a fantastic organization, and they certainly have a wide spread. So that's awesome that I'm sure people can find some of the information and content that you guys have shared just by visiting Bigger Pockets. So that's great to hear. If you don't mind, Patrick, let's just get right into some of these questions, give you
Yeah.
a chance to answer those, and we'll go down the line here. But I figured we'd start with the asset class itself. You know, for investors who may be more familiar with owning rental properties, in fact, we've got a lot of clients that own directly rental properties with their self-directed retirement accounts. Some of them are obviously participating in equity real estate deals. How would you explain the opportunity within private real estate lending and credit?
Yeah, sure. So I always like to make sure the first thing I do is really touch on our primary asset class that we do invest in, because this is a large attraction of why investors and specifically real estate investors come to PPR. Because our bread and butter investor is typically some type of real estate investor. Why they're still interested in PPR is they're still getting further diversification while staying under that, real estate umbrella, and even more specifically, residential real estate umbrella. So the primary and how we got really popular, the primary asset class we invest in is purchasing non-performing residential mortgages. The definition of a non-performing residential mortgage is pretty much exactly what it sounds like. So we purchase mortgages on primary residential homes where the homeowners are simply behind paying their mortgage, and by definition, 90 days or more behind paying their mortgage. So why would PPR or anyone really purchase a non-performing residential mortgage? Because A, it's obviously not cash flowing, and B, the homeowners are probably in some type of financial distress. So really what's going on behind the scenes there is PPR is purchasing large tranches of these non-performing residential mortgages from major banks that you're probably familiar with, say like a Wells Fargo. The reason for the Wells Fargo selling off this non-performing residential mortgage is number one, potentially they might have to, being forced to do so by the SEC. Because they can only have really a certain percentage of bad debt on your balance sheets in any given time, being regulated by the SEC. Obviously, this came from events like the '08 housing crisis, things of that nature. So that's a great opportunity for PPR. Number two, they might just want to. A large firm like Wells Fargo does not really want to put the time or effort realistically into a non-performing loan. They'd rather most likely just sell it off, get the capital back that they can, and just move on with their investments. And that's where PPR would come in, purchasing these at a considerable discount. What we'll do once we purchase these large tranches of non-performing residential mortgages is most commonly, and what our goal is to convert as many of them as possible into reperforming mortgages. The definition of a reperforming mortgage is simply put, the homeowner is back on track paying their mortgage for 12 months consecutively. Now, the number one question people will ask is, and fair question, the homeowner is not going to start paying their mortgage simply because PPR bought it. And that's absolutely true and correct. The difference between why they're able to get back on track when PPR bought their mortgage versus when, I'm going to just keep using Wells Fargo as that example, when Wells Fargo owned it, was because we're giving them a second chance to get back on track where the bank probably would not. So, and what I mean by that is typically a loan modification, which a black and white or simple scenario would be maybe this homeowner has 15 years left on their mortgage. They just one of the two income earners in the house just lost their job. Now they're 3 months behind. Uh, PPR will purchase or work with the homeowner to modify their loan, which could be as simple as taking that 15 years left on that mortgage back to a 30, which in theory that would cut their principal and interest in half. One other bonus, or what could potentially be a pro with a loan modification, is they can actually keep their rate. So primarily these non-performing loans were purchasing originated in 2010 to 2014. So their rate could be pretty advantageous. And what I mean by that is they're probably around 4%. So we go back to a 30-year, they can actually keep their interest rate, get those homeowners back on track with a significantly less or lower mortgage payment. I'll pause there if anyone has
I love
questions.
it. I love it. We did have a question come up, Patrick. It was not totally related. It had to do with contributions for the 2025 and 2026 year. Everybody should be able to see that. I went ahead and responded and mentioned that yes, absolutely. People can still make contributions to for 2025 and 2026. You could roll money into a self-directed IRA, invest in assets that Patrick's talking about with PPR. But Patrick, thank you for pausing. I love what I'm hearing. I feel like this is unique, especially coming from my seat. I see a variety of investments come and go inside of an investor's self-directed IRA. I've been doing this for 8 years, and this seems like an asset class or like an opportunity that's unique in this marketplace. And I say that because you're keeping people in their homes. You're obviously scooping up these non-performing mortgages, but it sounds like your team and your business model is to modify these loans so that you can keep the people in the homes, you could keep the payments cash flowing. It just might look a little different. They still get to retain their rate. So I love what I'm hearing, and I didn't know the full extent of what it was that you guys had to offer, but this seems like it's really unique. And how are investors responding to this opportunity?
Yeah, sure. So it's a not only unique, but again, I really want to emphasize it's great for diversification. It is under the residential real estate umbrella, which is most real estate investors' favorite place to be, mostly because of familiarity.
Yeah,
But it's very uncorrelated from most residential real estate opportunities or investments, such as, multifamily. If you're purchasing single family homes and renting them, Airbnb, whatever the case may be. This asset class is extremely uncorrelated. And why I kind of say that is typically we would be more profitable in economic and housing downturns. Whereas you have your multifamily property that you invested in or your single family residences, for obvious reasons, you're probably going to be more successful in economic upturns or increases from consumers having more money, especially if you're on the Airbnb side. More people have money to vacation or take that extra trip. Your residences are increasing in value from appreciation, things like that. So it's very beneficial as far as diversification goes for a lot of these investors because the how uncorrelated they are, even though you're staying in residential real estate.
love that. It kind of reminds me of like the differences between bonds and equities. So that's cool that you kind of laid that out there for us. Well, let's keep going. How do real estate debt investments typically generate returns, and how does that differ from traditional equity real estate investments?
Yeah, sure. So I'm glad you asked that because a large misconception is uh, most people think we would keep the reperforming loan. That's really not where we're looking to cash flow and or profit. For the reason of if we, like the scenario I said earlier, they're converted to reperforming, they're paying their mortgage, they're paying 4%. We wouldn't just keep that forever. Obviously, the profit of PPR would just be 4% annual. How the heck would we make 4% and still pay our investors a fair return? Our return really comes from, to give you more context here, we're purchasing about 50 to $100 million worth of non-performing loans at a time. Right now, we probably have right around $1 billion in total. The profit really comes from when we get a decent amount, let's say, again, in the 50 to $100 million worth at a time, reperforming, we're going to bundle those up and sell those back to a major bank. So for easy numbers, obviously it fluctuates depending on market. We bought this $50 million worth of non-performing loans for about 60 cents on the dollar. We've converted them to reperforming loans now. We'd sell it back a lot of times back to the same bank that sold us the non-performing loan. We'd sell them the reperforming loans for now about, let's say, again, just using round general numbers, about 90 cents on the dollar. So
Okay.
that's really where our profit comes from. We are not looking to sit and keep the reperforming loan for a long time. Again, because if it's a 4% rate, mathematically wouldn't be easy for us to make profit and pay our investors.
Awesome. Gosh, that's awesome how you guys have put that together and painting that picture. It does simplify what it is you guys are actually doing behind the scenes. Just curious about turnaround time on the time that you purchased those, that portfolio, those non-performing mortgages. How long does it take you guys to is it repurpose or not necessarily repurpose, but reperform those notes before you sell them for that gain?
Yeah. So when we purchase a tranche of these non-performing loans, a general timeline to wind down let's say 95% of it, or you're always going to have lingering ones that'll stretch much further. It will be roughly about 24 months, so 2 years.
Got it.
And to give you very general broad stroke of what your typical portfolio will look like, about 76% will convert to reperforming loans. About 14% we would have to go to foreclosure. We only purchase first liens, so if the homeowners refuse to work with us, we would typically foreclose on them and sell the property at market value. That last 10%, we would negotiate with the homeowners. Typically, they would be getting help from a family member, a friend, whatever the case may be, to negotiate a lower total loan amount and just pay it off in total to be completely out of water. So 95% of the portfolio will be quote unquote winded down in about 2 years' time.
Got it. And obviously, you guys have been around going on 20 years. You've obviously built all the internal operations to make that happen. That's
Yeah.
impressive. If you don't mind, let's shift gears a little bit, talk about market
Sure.
environment. Where traditional banks are kind of pulling back today, how does that open opportunities for, companies like yours, PPR?
Yeah. So the large banks are being more conservative right now, and in the way that it primarily affects us would be selling off more of their non-performing assets, even when they're not forced to, like I referenced earlier, sometimes they're forced to. So that's advantageous because when there's a supply increase on the non-performing loan side, it's only going to benefit PPR as far as how much we're going to pay for these non-performing loans. So there's a lot of variance, and I can touch on this a little bit more. There's a lot of variance on the price per non-performing loan we purchase, but one of the largest indicators is going to be supply, just like anything else in the market. But when there's a surge like this, which banks being conservative and selling off bad assets all in one in time or one short time, let's say a 12-month period, is going to significantly decrease what we'll pay for these non-performing loans, which keeps us less risky, putting out less capital for the same asset. And B, makes us more profitable on the back end, being able to sell it for roughly the same price when it does convert to a reperforming loan.
Got it. I was kind of thinking through the 60 cents on a dollar. Patrick, when do you typically, let's say we look at the lifespan of your company, PPR, when are the good times, if you will, for PPR to come in? Is that now? Are you seeing a lot of opportunity right now with non-performing notes? I mean, I hear about like what the Federal Reserve is saying about debt and, really the consumer's inability to pay back debt. Is that an opportunity for you guys? And is that now?
Yeah, sure. So I'll want to make sure I use my words carefully.
Yeah,
But to your point, you've kind of driven it home right on the mark. So not that PPR ever is going to root for negative economic factors in the United States, but it certainly is true that to Joel's point here, typically in this type of scenario, it is beneficial for PPR. To your point, number one indicator of what will probably help us, right, is going to be an increase in unemployment. Increase in unemployment is a direct correlation to less people being able to pay their mortgage for the obvious reason they don't have the cash flow that they had 6 months ago, let's call it. That's going to directly correlate to an increased supply, like I just referenced a minute ago, in more non-performing loans. When that supply increases, we're purchasing this now at a discount. Which time periods are most favorable? I always give, and if anyone is a Bigger Pockets fan, our founder, who's still with us with the company, Dave Van Horn, tells some pretty interesting stories about the 07, 08 housing crisis, where when I tell some people, oh, we were founded in 07, 08, they usually go, oh my gosh, that was a tough time. Quite the opposite. You're asking the wrong question. It was quite advantageous that the founders founded the company right before the 08 housing crisis because, and probably or hopefully, we'll never get non-performing loans for this type of price, but our founders were purchasing non-performing residential mortgages in the 08 housing crisis for about 3 cents on the dollar. Now put that in perspective. You buy a $100,000 mortgage for about $3,000. If the home or if the mortgage were to reperform and you can sell that for 90 cents on the dollar, let's say, your profit's pretty exponential. If it doesn't reperform, the risk on the downside is pretty low. So yeah, to answer your question in short, economic instability or downturns typically are going to favor this type of investing strategy. And to your point here, especially with a lot of economic uncertainty today in the present, even as close to recent as 2026, the last, let's call it 90 days, certainly a more favorable
Sure.
position for us to be investing in non-performing loans.
Yeah, for sure. I appreciate you kind of going into that and touching on the elephant in the room. And I just want to highlight, you said at the very beginning, PPR is offering, diversification in somebody's real estate investment portfolio. So I think it's important that we had a chance to touch on that and highlight what you just said. So gosh, let's move a little bit into the company and the culture, if you don't mind. PPR, you guys have been active in real estate for many years. What differentiates your guys' firm's approach from other private lenders?
Yeah, sure. So number one thing, the obvious one that differentiates us is our timeline and existence in the space. So within private equity as a huge umbrella, and when someone says private equity, that is extremely general. There's probably 100 different industries within private equity, but I'll refine that a little bit to private equity and more specifically real estate. It's extremely impressive and telling when you have the track record we have from 07 to present day because of what we went through, right? Let's think of the two biggest indicators or market cycle extremes would be 08 housing crisis, but really more difficult and probably more impressive for all, not just PPR, all private equity companies within real estate would be COVID. So COVID was very unique because it wasn't a situation where the market conditions were unprecedented and huge drop-offs like the 08 housing crisis, but it was a completely unique time period in that the scenarios ahead were extremely unpredictable. So this is now being predicted by what certain things, the policies of who's in charge will be in place versus your house maybe decrease in value 30%. Well, your standard way of talking through that with someone would be obviously don't sell at the bottom. Your value will come back eventually. Whereas in COVID, it was very unprecedented time. There's not really anything in the past that you could have based your investments off of. So I think the biggest thing that sets us apart would be going through unique times, both in great economic conditions and extremely poor, and being able to keep the trust and honor and our promise to our investors over these 18 years of delivering the rate of return that they signed up for and that we promised and kept our word. But also being able to deliver whether it was great times with PPR and our profits were phenomenal or very difficult times with PPR where returns were hard to come by, but we made sure we put the investor first. Because at the end of the day, in this type of space. If you lose the trust of your investors, your company's probably not going to be able to hold up long term.
Well said. When PPR identifies an opportunity, what are the most important factors that you guys analyze before deploying capital?
Great question. Yeah, so I always like to make sure it's clear. We don't just purchase a non-performing loan because it's a non-performing loan. So picture it as like there's a trade desk that you can purchase these non-performing loans on. The great news is you get a heck of a lot of details on the specifics of this non-performing loan. And what I mean by that is the value of the property current day, the loan to value, so what they still own on the house versus what it's worth, location, and that's extremely important for the main reason of what state is this property located in. We purchase non-performing loans in all 50 states. What we will pay for a non-performing loan in the state of New York versus the state of Texas is significantly different. We could foreclose on a property in about 90 days in the state of Texas if the homeowners said they don't want to work with us. Not much risk there involved because we have a dead asset that's not cash flowing for now 90 days. You take that same exact property, same exact worth, everything stays the same, but you move that house to New York. Now you're looking at a foreclosure process that could be significantly north of 12 months. Now we're putting capital on the line where we might hold a dead asset that's not cash flowing for 12, 14, 16 months before we get it legally able to get it sold and get our capital back. So there's a heck of a lot of due diligence and underwriting that goes behind which non-performing loans we purchase. I'll give you our general threshold, and obviously specifics change depending on every scenario. But typically, we're purchasing these non-performing loans that originated in 2010 to 2014. That's very important because the equity in the property is a driving force of why we're going to purchase this. So now we have a homeowner who's been paying the mortgage for 15 years, and we have a property that's been appreciating for 15 years. Number two, we'll shade towards landlord-friendly states, like I mentioned, so like a Texas, a Florida, things like that. But to be clear, we do purchase non-performing loans in all 50 states, and we're happy to purchase non-performing loans in all 50 states just for the right price. So sometimes we're more heavily shaded towards a state like New York or California, but we're just paying much less for that non-performing loan. Over our $1 billion portfolio of non-performing loans, our average loan to value is about 55%. And I really want to drive that home because that's extremely important. What that means is we have quite the wiggle room in how we exit this deal. First and foremost, we obviously want to convert the homeowner to a reperforming loan, which is much easier to be done with a 55% loan to value because you have such a motivated homeowner. The homeowner didn't buy this house in 2025 with 3% equity. They really built up a lot of their life savings in this primary residence. They are much more motivated than PPR is to want to keep this house and get back on track paying and work with PPR ultimately. So it's a win-win for both scenarios there. And to drive that point home a little further, the fact that we are purchasing these non-performing loans in the years 2010 to 2014, I like to kind of make sure I emphasize that those are not special years or years that we want to target forever. It is simply pretty much as far back as you can go while still having liquidity in the market. So we would purchase mortgages in 2005 if we could, because you're further back. There's just not much liquidity. Why we're in these is that's pretty much as far back as you can go and pretty significant liquidity in the market. So forever, or theoretically forever, we're always going to be about 10 to 15 years lag time behind present day. So eventually 2010 to 2014 will dry up. And then at that point, we would just be 2012 to 2016 and then theoretically forever, just moving up your dates as we go along.
Awesome. I appreciate that breakdown, Patrick. And if you don't mind, let's pause and address a question that actually came up from Greg.
Absolutely.
I appreciate this. I'll read it just so anybody who might just be listening can hear it. Regarding what you pay for the non-performing mortgages, do the banks set the rate or do you negotiate what you pay on the dollar?
Let me make sure I understand the question correctly. Okay, regarding what you pay for the non-performing mortgage, do the banks set the rate or do you negotiate what you
I know you.
the rate itself was just whatever it was at the time the loan was originated with the bank. What we're
I,
paying for is negotiated. So if the house is worth 200,000, this is just very simple numbers. If the house is worth 200,000, they have $100,000 mortgage left. Um, the negotiation is maybe we say we want to pay 55 cents on the dollar, so we want to pay 55 grand for that mortgage. They say no, 65 grand, and then we meet at $60,000. And essentially how we get to where or what we pay for it.
cool. That's awesome. So PPR really does have a voice in that negotiation as you guys are picking up these tranches. Um, Fantastic. Let's double check here. We might even have, yeah, that answers the question. That's Greg's response. So that's perfect. Thank you. Um, okay, well, let's go ahead and keep on moving here. If you don't mind, I might ask one more related to company and culture. Um,
Sure.
how does let's see here. How do you structure your investments so that your interests remain aligned with your investors? I'm sure you over the last several years, you being in relationship management, you have your ear to the ground when it comes to investor sentiment and voice. How do you guys remain aligned?
Yeah. So a couple of things there. And I guess there's a couple of ways I can take this approach, but I'm gonna take it as how do we make sure we're aligned with delivering on our promise to the investors essentially. Which brings another great point of why this asset class is pretty strong. So with non-performing loans, number one, there's quite a bit of liquidity within the asset. I know I mentioned liquidity in the market. Let's take it from the approach of how quickly you can buy and sell this asset because that really strengthens PPR as a firm. We can buy and sell these non-performing and reperforming residential mortgages pretty much as you can buy and sell a stock on your phone right on the app. So it's about one business day, which is extremely important as far as cash flow and liquidity, because you could be with a fantastic company that does extremely well in hard real estate, but it doesn't matter how good they are, they're going to run into some liquidity issues at some point because it's a hard asset. You can't just pull capital out at any point. Again, it can be the best, real estate investment company in the world. They'll probably have some type of liquidity issues just because capital's locked up. They're not ready to sell off XYZ portfolio or properties, whatever the case may be. With us holding over $1 billion worth of non-performing or reperforming loans, we would never have a liquidity issue. Um, and that being said, the full cycle of an investment is much shorter than your average in a hard real estate deal. Let's say that's 5 to 7 years, very general or typical of the industry. Ours is about 2 years. And you have this large of a portfolio, we didn't buy all these $1 billion worth of non-performing loans at the same time. They're all in completely different stages of where they are from. We bought them yesterday. They're completely non-performing. We're trying to get in touch with the homeowners to start the process of modifying the loan, all the way to a certain percentage that are on time, paying the mortgage back on track again for 11 months. And next month is now by definition of a bank considered a reperforming mortgage, all the way to we have this basket of reperforming loans ready to be sold. We're just packaging them together and then looking to sell them off on the marketplace. So to align with always having our perfect track record of never missing an interest payment, never paying lower than our promised rate with our investors, having a asset that's liquid, never having dried up or liquidity issues, and also a staggered approach of our investments being on completely different timelines from each other always ensures that we have the capital and return on a monthly, annual, semi-annual basis to pay our investors.
Got it. Thank you, Patrick. Let's move on to another topic here. I know we're already 35 minutes deep into the conversation. Um, I'd like to jump into, loan structure, risk. We've talked a little bit about how your company does manage risk. But let's dive a little bit deeper. For investors who may not be familiar with the mechanics of private real estate loans, can you walk us through what a typical loan might look like from origination to repayment?
Yeah. So I touched on this a little bit. Predominantly, though, we're doing loan modifications, which again, a few key pieces here. The homeowners have had this mortgage for on average about 10 to 15 years. We would primarily be doing a loan modification to pull their mortgage back to a 30-year mortgage, which again, in theory, is going to cut their principal and interest in half because they can keep the rate they had. The great part of that is it's an and or. We have the flexibility to allow them to keep the rate they had, which again, for simplicity, it's going to be around 4%. And obviously, for anyone who's purchasing real estate anytime recently or soon, you know that the interest rate's significantly higher than 4%. But let's say it wasn't. We could also do like a refinance scenario. Let's say they had a 7% rate and today's market rate is 4. We could also do a refinance scenario to be able to change their rate. So they really get the best of both worlds, whatever the lower rate would be at that given time between what they currently have and what the market rate is, let's call it. At that point, they're on a completely new loan term sheet. So their old loan does not exist anymore. They're now paying this mortgage to, for the time being, PPR, and consistently for 12 months going to be paying their mortgages to PPR until let's call it the marketplace, now defines Mr. and Mrs. Smith's mortgage as a reperforming loan, no longer a non-performing loan. At that point, we would sell that non-performing loan back to a major bank, again, like these large banks that you're very familiar with. And then typically, like any other mortgage, it's common that Wells Fargo bought it for 90 cents on the dollar, scooped up some interest, and then 6 months later, they sell the loan. Like for any of you who own a mortgage, you've probably seen your mortgage has been sold at least one time in your years of owning that property.
Right on. Let's move into the SDIRA context. We've got investors listening today or, listening to the recording that might be considering a self-directed retirement account to broaden their diversification in their retirement. They might have one currently. They might be investing with PPR actively. I'd love to get your perspective and just share with us what you've observed about investors who allocate through self-directed retirement accounts versus personal capital.
Yeah, it's a major, major advantage, and I can give some context to why. But ultimately, again, like Joel mentioned, we met, I don't know, at this point, 6+ months ago, first time, just on a Zoom call, just like this. And we both kind of gave each other what our day-to-day looks like at our companies and why we can be beneficial towards each other. I sent Joel a contact within a couple days of meeting, and that was a all-in-one day completion. So Heritage IRA really is a phenomenal firm to work with. Most importantly, in the industry, it's really important that you can actually get someone you trust and know on the phone and not going into a call center or something of that nature. But why it could be beneficial as far as investing goes is really, in theory, if you invest in PPR with the self-directed IRA, you have no tax obligation. And one of the most important things I want you to do with PPR or any other company you invest in is ask the question, are you exposed to UBIT tax, unrelated business income tax? This is a tax that can be triggered even though you're investing in a qualified account or a retirement fund by investing in things that A, have leverage, or B, are involved in real estate. It is very important because that tax hit can be pretty significant. And some people don't realize it until it's too late and you already owe that tax bill. We are at this point, our fund, our fund as a whole with assets under management is about $1.6 billion worth of residential real estate. Our investor base at this point is north of 35% coming from qualified accounts, self-directed IRAs. 5 years ago, I would bet you that was probably somewhere between 10 to 12% to give you perspective on that. So it has really increased. I think self-directed IRAs were confusing and not very household knowledgeable. And the further we go here, I think more and more people are understanding what a self-directed IRA is, how to get exposure to a self-directed IRA, and it being less complex than maybe originally thought of what you can invest in. I think scary part of not knowing about how it works and things like that kept people or deterred them from doing a self-directed IRA, the more comfortable and knowledgeable people become, I think that number is only going to increase both at PPR. I think in the near term, it'll probably hit 40 to 50% investments coming from self-directed IRAs. But outside of PPR, I think this whole industry is going to see a huge shift because of the obvious benefits investing from a qualified or retirement account versus typical cash.
For sure. I appreciate that so much. Let's start getting close to the end here. Maybe a couple more questions, if you don't mind, Patrick. Um, Thinking about investor due diligence, when someone is investing retirement dollars, money they've spent decades building, what level of due diligence do you believe sponsors should welcome from investors?
Yep. Yeah, absolutely. Great question. Uh, there should be a few thresholds for yourself before trusting someone, and this varies greatly depending on your experience within the private equity space. So if you're a 10-year plus vet, I'm sure you have your own due diligence plan, but especially for beginners, there's a couple things. And I'll also add a few tools for you. So number one would be track record. Understanding how long they've been in the business. Did they just open their doors in January of 2026 and promising you all these great things? Because at the end of the day, anyone can make a company and tell you you're going to get a 35% annual return, right? But ultimately, what have they proven that they can do? And can they surpass kind of like that quality of time where not only have they been around a while, but what kind of turbulence have they hit within the market? Like I mentioned, some cycles that PPR has gone through, like the housing crisis or COVID. So I think a very important threshold would be how long has this company been in the market for? Their track record in the asset classes that they have or have utilized, and the investor experience. Which brings me to my next point that's very helpful. But well, I guess two. Number one, I'll mention Bigger Pockets again. I've given them so many shout outs today. I should be getting a paid sponsorship, but I promise I don't work for Bigger Pockets. But they actually have an investor forum where investors or anyone part of the Bigger Pockets organization can leave reviews, experiences with certain operators, companies, things like that. And then it's kind of an open dialogue type scenario where someone said, "Hey, I invested in PPR in 2018." Someone says, "I invested in PPR in 2022," and they kind of give an honest review. It's very beneficial. I've used it personally. I've used it outside of looking at for just PPR, but also companies that I've been interested in personally. And to kind of piggyback that is a newish, it's probably been around for about 2 years now, website called Invest Clearly. Again, I'll repeat that, Invest Clearly. All of potential investors that come talk to me really appreciate this and benefit from it. So I'll absolutely make sure to touch on what it is exactly. But ultimately, it's a website created for a marketplace for people to go to and get honest and open reviews of pretty much any company in the industry and the investor's experience. Why it's a little more verified or helpful than maybe the average website is this website makes you verify with them before you leave a review that you are or were a current investor with the company that you're talking about. So any of you right now could go to Invest Clearly. You type in PPR Capital Management, and you can see reviews and experiences others have had with us. And you know that a third party, completely unaffiliated from PPR, completely unaffiliated from any other company on there, verified themselves that they had proof that they were or are an investor with PPR. This is beneficial because a lot of people come to me and say, "Can I talk to some of your current investors?" I can't legally do so because of investor privacy law. I'm not allowed to give you someone's phone number or email or something like that. So that is always my roundabout way to say, I can't give you anyone's personal contact info, but if they share their own information online, here's a resource for you to go and find it.
I appreciate that so much. Invest Clearly. I'm definitely going to take a look
It's
immediately for
extremely
sure.
beneficial. Yeah.
Yeah. Okay. Love it. And then, of course, Bigger Pockets. Great forum, great platform for investors for sure. And then, of course, track record. Thank you. Let's wrap it up with one more question from myself, and heck,
Sure.
we might even open it up if we've got a few more minutes here at the end to anybody else. But um, first-time investors, what kind of expectations should these investors have around timelines, reporting, communication when investing with PPR?
Yeah, absolutely. So typical timelines, private equity in general is a pretty illiquid way to invest. So I always like to emphasize our bread and butter investments, lockup periods are typically about 3 years time, 36 months, where you do not have the option to get the capital out early. So you invest today, your capital will be with us until March of 2029, theoretically. We are pretty current and really try to push the envelope as far as transparency goes in this industry. And what I mean by that is number one, as far as being transparent, we get third party audited voluntarily by Deloitte to show our financials. And in black and white, the main question we want to answer for investors is A, our financials are true, and B, we're not a Ponzi scheme. So we are not stealing from Peter to pay Paul. We actually have financials that are third party audited that show dollars in and dollars out. We're actually making money. These investments exist in the United States. We're not just making this up, taking your money and looking to create a Ponzi scheme for a while. Again, why I referenced kind of a couple minutes ago why track record is so important. Moving on from beyond third-party audited financials would be quarterly updates. So once a quarter, we really do a top-down review of what did we buy, what did we sell, and what is our next quarter looking like as far as asset allocation, capital redemption, things of that nature. And you're not only going to hear from me, because all investors, or a good portion of them, you're usually stuck talking to me, but these are a good opportunity to actually hear from our C-suite, from our chief investment officer, our CEO, our chief client officer. You can hear from them for a little bit change of tune and probably more information that I can even provide about the firm, where we're currently at, and things of that nature. So it's a great opportunity to at least 4 times a year hear from us. And beyond that, we send weekly newsletters, monthly announcements, things of that nature, but they're a little less formal than, say, our quarterly updates.
Perfect. Patrick, this has been great information. We had a couple of people that had to drop off, but they were sending me messages on the side and just showing appreciation. So we do appreciate your time, your effort that you put into this. And I think one great way to wrap this up is ultimately, how can individuals get in touch with you?
Yeah, I appreciate that very much. So I'm going to provide Joel best contact information for my email and phone number, as well as provide a direct link to my calendar to schedule a call. So I believe, Joel, you mentioned you'll be sending something out further tomorrow or this
Right.
week. So
Yep.
I'll make sure Joel has all the correct information to be included on there. Feel free to reach out to me anytime, again, via scheduling a formal meeting with me, or if you email or phone call, I'm happy to discuss with you as well.
Phenomenal. Okay. Well, Patrick, thank you so much for your time. We'll have to have you on again later in the year. And I appreciate everybody for taking some time out of their day to tune into this, even if it was just the recording. We encourage you to reach out to Patrick. Reach out to us at Heritage IRA. If you've got questions, we'd love to hop on the horn with you and understand what that looks like and how we can best serve you. So appreciate everybody's involvement today. Patrick, thanks for coming on, and we'll talk to you later.
Awesome. Thank you very much for your time, Joel. It's very much appreciated.
You're welcome. Take care.
Take care.
Bye bye.